Welcome back to the channel. I'm Foreman, and in today's video I'm going to be showing you the UK stocks I'm buying, as well as an update on a few different companies such as WH Smith's, Distilled Psc, a small company that you may not know of, Matalan, Primark, and also Boohoo. So if you'd like this video, please drop one of these to help beat that YouTube algorithm. It is much appreciated. So without a doubt, my portfolio has underperformed yet again. So when we take a look at my spreadsheet, this is a wrong one, we can see that I'm actually down 4.50% for the week, and this is a drop of £814.64. Yet again, obviously my large holdings have declined, and that is perfectly fine to me because ultimately this is going to happen. This is natural market volatility and something I really don't concern myself with. Recently I explained to my dad, and I was talking about the stock market, and I said, well, if you have a motorbike and you told me that actually that motorbike is a good investment, if you get it, buy it, put it and store it away in good condition for a few years, like 5-10 years, then it will likely do well. And because that he would know the stuff about the motorbikes, for instance, it might be a Honda Fireblade, which is one he has, he would then be able to say, right, okay, that will go up over time because it becomes more collectible. Perhaps less parts are being made for it, and therefore there is more of a demand. I'm saying the same thing about the stock market. At the moment, these stocks, clearly people are selling, but just because Boohoo is down 43.94%, it doesn't mean that I am going to sell. Instead, I feel that the underlying business is going to appreciate over time, and this is because they're growing upon their fundamentals. Recently, they had that 32% revenue growth in the UK, but they did decline in the rest of the world, which is certainly eaten away. And yes, their earnings are declining, and at the moment, their free cash flow is negative, but then again, they have made a lot of expenses in the last year due to the acquisition of Debenhams, Burton, Dorothy Perkins, and Wallace. Speaking of Burton as well, I bought this shirt very recently. It was one of the last ones in stock. I'm actually really happy with the quality they give. It's definitely a step up from the products of Boohoo Man, for instance, as I've always found that Boohoo Man products seem to be very cheap feeling. I mean, I always used to wear Primark clothes, but this is definitely a step up from Primark. But then again, I think that's also reflected in the price tag as well. So I've also got the stock tracker updated. If you're interested in that, it is available on my Patreon. I've now changed it to fit the format of my current holdings, and hopefully it has a little bit more value. According to this, in the 17 days that this sample portfolio was going, it would be up 5.34%. Pretty impressive in my opinion. And yeah. Okay, so Associated British Foods is the parent company of Primark, but they also run, obviously, their total food point of the business. I always found it a bit of a weird blend, but I'm only here really interested in the retail section, which they have seen a change at constant currency of 36%, meaning their revenue has grown by that much. However, when we actually dive into it, we have to zoom in here because it's very small, we can see that sales in the UK stores were well ahead of last year, but their like-for-like sales compared to 2 years ago were 10% down. Which, to be fair, if you compare back 2 years ago where they did have the stores open, being 10% down isn't actually a bad result if we really factor in the fears at the moment of, let's say, the pandemic, which seems to be easing away now as we're now just saying, screw it, we're going to release restrictions. But it's certainly not that bad at all. And they said that total Primark sales in this period were 5% lower than pre-pandemic levels. So I think this is quite impressive. It's showing actually this is definitely a very resilient business, and that they said that their profit margin in the period was ahead of their expectations and is expected to be over 10% at the half year. But they've also mentioned that they have seen sales densities recover, but they've also seen the effect of inflationary pressure on raw materials and supply chain has been broadly mitigated by a favorable US dollar exchange rate compared to last year. So effectively, the reason why they've done quite so well is because they've had obviously that exposure to the dollar, for instance. They're now looking to simplify their in-store UK retail structure as part of their ongoing program to improve the efficiency of their store operations. You may have noticed in the news in the last week that I think they got rid of about 400 employees for a few of their retail stores, so they're looking to really cut down. It's a shame really, because I would really like to dive deeper into Primark, and if it was like a spin-off and they split between the food business and also Primark, I think it would be a very attractive brand to have on a watch list, for instance. But it's always good to be comparing this to other brands that you've got a general awareness of what's going on in the industry, even if this is a retail high street retailer. We've also got Matalan. Now they're, I believe, a subsidiary of their holding company, which is Missouri Topco Limited. However, they've announced, and this is a private company, by the way, hence the limited sign, and this is why you may not have heard about this. You will likely know of Matalan, but effectively they retail clothing and homeware in the United Kingdom. They've said that their revenue has increased by 19% in the last 13 weeks, and that actually their overall revenue in the 39-week period has increased by 34.6%, so quite impressive, but it very much depends on where they're comparing back to. But they've also mentioned that the cost of sales has increased by 20.3%, which is a phenomenal step up, and that their gross profit has actually increased as well. I'd be quite interested to see what their net profit is. Operating profit down here, pre-exceptional items, has increased by £7.4 million, which is suggesting there is a positive swing in this. I really don't like the layout of this. I wish they had done it with graphs or something, but it is a shame. But they have also mentioned that their cash flows from operating activities has decreased by £5.3 million to £44.2 million. This may suggest, obviously, the demand, perhaps the logistics, for instance, is also impacting this business as well. Although I believe, as far as I'm aware, this company, I should have read from the consolidated income statement, it would have been a lot easier. I believe they are only located in the UK, and so that their sales, obviously, are not going to be as impacted by shipping logistics, other than importing goods from elsewhere, because a lot of their sales will be made in the UK. But you can see obviously that step up in the cost of sales here, although to be fair, it seems fairly reasonable, and perhaps their cost of sales in 2020 was less. It'd be nice if they compared back another financial year, but then again, it's hardly like they're a public company, and so they don't really need to do this by any means, but they have seen an increase obviously in their operating profit. This brings me on to Boohoo, obviously my biggest holding in the portfolio, and they've seen Jupiter Fund Management PLC, which was their third largest shareholder in the stock for quite a while, has actually lessened their stake. Now, I posted this on Twitter and people going to me, no, this is bad news, this isn't good, why are you still bullish on Boohoo? And this is because their total assets under management, or AUM, of Jupiter Fund Management PLC has been on a steady decline for, I believe, the last 1.5 years. So what's happening is as shareholders are selling out of this fund, their total cash inflow is reducing. In fact, there's outflows of cash going back to the shareholders. And so since their assets under management is reducing, they are then forced to therefore reduce their position sizes. If they were no longer bullish on Boohoo, then they likely would have decreased their stake from 9.99% to nothing, instead of retaining a 4.7% stake in the business. Now, this could also be a form of burying their losses, but again, they would have sold it to zero and then moved on. It's hardly like they're trying to take a quick loss or anything, and it could be in a way harvesting for taxes as well. So that would be quite interesting to see how this plays out over the next few months, because at the moment, what is it, January? How do I need to check that? But if it's in January, and let's say when the tax year resets in April, we may see them increase their stake again if they believe shares will stay quite low. But what it does explain is why we've had quite a bit of negative sentiment in the shares over the last month or so, as they were obviously liquidating their stake, and it's natural. I think this is perfectly fine. Yes, you've got less institutions invested, but I think that's a good sign. The less analysts, the less institutions that are really following a company is a good thing, as it means that the valuation of the company could be materially ill represented, meaning that they could be significantly undervalued. And in fact, this is something that Peter Lynch talks about in One Up on Wall Street. I'm about halfway through the book. I don't think you can see it on the camera, but it's where my bookmark is. And I've learned quite a few valuable lessons so far. So if you're interested in this, I've got a link in the description down below on the Amazon books that I like. Regardless of this, I am obviously going to still be holding Boohoo, still be buying more. And on Friday, in fact, it did test me. I had a cash position of roughly 2%, I believe, but that's only increased because my portfolio has decreased. And I felt that actually I was tempted to buy more and then not have any more for the next week, but I've got to stay disciplined. I'm just going to continue scaling into this position. I think Boohoo shares could be down for the next 12 months. Again, that's only speculation, but I have a feeling it may not bounce back as quickly. And because I feel that's the case, I should take my time. I should continue to average down on the position and lower, obviously, my average share price so that I'm well set for the longer term. term, but also not get too greedy where I buy or I use all of my purchasing power now and then the stock declines another 20% and I've missed out on the lows there to also purchase in. Also, it helps with risk management in a way so that I don't obviously become way too overexposed, even though I have obviously got a large exposure, and let's say the next trading update isn't good, shares drop even more and I might decide actually I want to sell. At least then I had some cash that I didn't invest just yet. But no, I'm not building a cash position at the moment because my two highest conviction stocks are on a decline. I'm going to be buying those stocks. Unilever has been a very interesting stock in the last week and it has been very questionable at best. Now, they were in the news and you likely already know about this because they were looking to acquire GSK's GlaxoSmithKline consumer healthcare brands, but the acquisition value of this was phenomenally large. Now, I'm not sure if it mentions it on this one, but they're saying that they believe it's a highly complementary category for Unilever with good potential for synergies and a number of routes to build scale. And they said, let's have a look here. Yes, they mentioned again synergistic combination. I like that word, but where is it? It doesn't quite say on this update here, but what the concern was is that by Unilever had stated they were interested in GSK. So they did make an update where they said the idea where they were looking to perhaps dispose of some of their underperforming brands and that they felt that this was a great acquisition for the company and the growth, and it made a lot of people question the management. And I believe figures of something like 80 billion euros were mentioned, although they did disclaim that they're not going to increase their offer above 50 billion pounds. Unilever's market capitalization is not something I've checked recently, but from what I remember, they were sitting on about 90 billion pounds, I feel. And so that is a huge acquisition to be making and would represent a lot of operational debt load and perhaps some logistical concerns for the business. So it is very questionable. But obviously, if they're not looking to increase their offer above that amount, then that means that the shares have in fact declined perhaps for no reason. The reason behind the decline in shares might just be because now people doubt the quality of the management because they're saying some of their brands aren't that great. They don't have purchasing power. They don't have brand dominance, and actually they want to get rid of these brands and buy another company's brands at an overvalued valuation, which seems a bit ridiculous in my opinion. In the past, I did hold Unilever, and at the moment, I believe they have something like a 4% dividend yield. But that's not sustainable if they're taking on a load of debt if they purchase GSK's consumer healthcare brand. Now, I have got a Patreon. If you didn't know, check out that link in the description down below. It's how you get live access to my holdings, amongst other things. I've also revamped the Discord, so it's definitely worth taking a look in there as well. WH Smith's, formerly known as the worst retailer on the high street. People always look at these stores and say, what? What's the point? I've got my folder, I've got this. And to be fair, to someone that isn't really paying too much attention to it, you would think this is a horrible business. Why would anyone invest? But I quite like it. And this is because they are very well located on travel hotspots. So as domestic travel increases, in fact, they'll seem to benefit. And you can look at places like London Euston, where they've got, I believe, 2 stores of WH Smith's. And in pretty much every main travel hotspot, such as train stations, hospitals, airports. Hospital isn't really a travel hotspot, but it is taken under that category. They've got a store. And you may or may not go into that store, but they are well placed to benefit from the footfall. And that footfall is always a positive thing. Now, their trading update in particular has been, it's very misleading to say the least. What they've said is their total group revenue as a percentage of 2019 total revenue. So this already gets confusing. They have seen, in fact, their total revenue in the high street by roughly 85%. That is what it is of 2019's revenue. And that their travel is dragging that down a bit, but actually the high street is also pushing it up slightly. But when you look particularly at the UK, you can see that obviously the airport's destroyed. Like, at the moment, they're not getting much footfall. I believe some of them are even still closed as far as I'm aware. And so they're not going to be getting much revenue. But the hospitals remain consistent, for instance. And the rail lines remain at 2/3 to nearly 3/4. And so what we can see here is that perhaps with a good recovery, that this can do very well. They mentioned that their liquidity of their trading performance or their cash generation was ahead of plan. And they have access to £345 million of cash on deposit of £95 million and an undrawn something cash flow, represented cash flow, something like that, of 250, or retained cash flow very likely, of £250 million. So depending on its valuation, it's definitely one to watch in my opinion. We've also got best of the best. Now this is a stock I held in the past and it performed worst of the worst. And in fact, this was a mistake I made. I believe I lost something like 60 to 70% holding this stock, although it was outside of my ISA and also my pension. So I can harvest the tax loss on that and obviously pay less taxes this financial year. But best of the best was a good company, or at least it had a good run where it was getting a lot of inflow of customers. They were betting on these competitions to win online cars. However, what I realized after making the mistake of purchasing and losing a lot of money, that actually they don't have a moat. People can easily get in and compete, and competition is rife. At the time, obviously the bookies, for instance, the bookmakers, and a lot of other betting places weren't able to offer many bets because the sports were down. So obviously they were well positioned to do well because people were like, yeah, I'd like an Aston Martin. I'll put £1 on for the raffle, see if I win. And so obviously they had a great run. And they're still a good business, don't get me wrong, but they've got obviously no market dominance. There's nothing stopping another company with more capital from out-competing these guys. And especially now that they're online only, it does make it a lot more tough. What they've mentioned is that the cost of acquiring players has increased a further 37% in November and December, which obviously means it's a lot more difficult for them to make money. Originally, it was the fact that they could advertise on Facebook, they'd get a lot of that back, and they'd make their money back within like 3 months or something, which was great. But now people are doing it, they're probably doing it for 2 weeks, and their loyalty isn't staying either. But they're a profitable, cash generative business with no debt and a supposedly loyal customer base. So you would really need to look at the valuation of best of the best. But when you look at their net assets of 6.35 million, which is supposedly underpinned by property and cash, it's not really much on the book, to say the least. And when their total revenue is supposedly in line with management's expectations after they dramatically cut their forecasts, so it's 19.12. So 1-2 even. It's not a bad company by any means, and it may be good for a recovery turnaround play, but I don't think all that long term as a business it will do that well. And it seems like their marketing spend, as far as I'm aware, I've not been really receiving these adverts anymore. It seems to have decreased there as well. Argo Blockchain, another former holding that I held very closely tied to Bitcoin, as they're a Bitcoin mining company, but they're also blockchain, so they are obviously looking elsewhere, has now decided they're going to allocate 10% of the company's crypto assets in their hodl, which is about, 200 to 300 Bitcoin, might be about 2,500, no, sorry. I think their total holding was about 2,500 Bitcoins. So we're looking at 250 Bitcoin, something like that, to Argo Labs. They're going to focus on 2 key areas: network participation and strategic diversification. Again, this seems like very much something that's trying to tick boxes, but I suppose it's a good thing. If you don't want to be invested purely in a Bitcoin miner, having them do their own thing and explore crypto-related projects could be a bullish sign for you. I ended up selling this stock at roughly a 50% loss, and this is because I really don't understand Bitcoin, I don't understand cryptocurrencies, I don't understand the blockchain, and I certainly do not understand NFTs or non-fungible tokens, especially when you see someone on Twitter that's got a picture of an ape and their name ends in .eth or .ethereum, and I'm thinking, I'm just not going to listen to that person, because usually they have no substance to back up what they're saying, as it got quite annoying with everyone saying Bitcoin's going to do this, Bitcoin's going to do this. And now look, I'm not hating on Bitcoin. It may do well, it may not. I sold out, I cut my losses at a very late point, and so far I've dodged quite a dip. I think I would have gone from about 50% down to now about 66% down. So I've certainly saved myself that loss so far. But then again, it may bounce back, it may recover, but I feel that it is definitely a high-risk equity that is very much tethered and performs similarly to the stock market, rather than saying it's a hedge against inflation. And so I'd rather not be on the downside receiving end of that, especially if I feel it doesn't really have any underlying value. The technology itself looks promising, but then I'm not well researched enough to know exactly what it does and how it may impact our society in the future. So it's best for a simple person like me to stay away, which is exactly what I've done. Speaking of something that is a little bit more simple, this is Distilled Psc. They are the owner of a premium drinks brand, Red Leg Spiced Rum, Blackwoods Gin and Vodka. I'm not going to go through all of them, but Red Leg Spiced Rum is one you may have heard of. Now, I like this company. Believe it or not, they're valued at something like 10 to 12 million pounds. And they're certainly one I'm watching. I mean, they're a very, very small stock, so the spread's going to be high, the liquidity is going to be low. And this isn't a recommendation to buy by any means, but it's definitely one I'm watching. Yes, they have mentioned that their revenue, the year-on-year figures were down 28% versus the same period in the previous year, although they're up 23% from pre-COVID. However, their cash balances have amounted to 4.1 million, which is good. But this is where things get complicated. So they've got an Argo distillery. I definitely have butchered that word. And it is somewhat west, I believe, of Glasgow by about 40-50 miles. And this isn't theirs. But what they're saying is they've made a deal with the people that run the distillery to produce their own spirits through that. And I think they're looking to create more whiskey. I think that was what they're after. They've got a rum brand. I think they're now looking for whiskey, so why not go to perhaps a Scotch distiller, and that would be very good for them. But they're trying to create this more into a tourist attraction. However, the facilities and the way they're dealing with this is quite confusing, because they're on about some loan in particular that represents something like £6 to £7 million. And I'm not entirely sure how this one works out. But for one of those that believes perhaps this stock, there's not a lot of understanding in it, and there's a lot of work to be done, if you know exactly what you're talking about with these types of businesses, then this could be an absolute steal in terms of valuation. And it really depends on what you think of these brands. They are obviously going to suffer with competition of like Diageo and AB InBev, even though they don't really make spirits, but obviously they're a good example, again, because I believe alcohol to obviously be a discretionary choice. You're either going to drink spirits, you're going to drink beer. You might go, I'm going to have beer. That's another competition for someone that wanted to be drinking, for instance. Now, they have mentioned that their export sales have increased by 16%, benefiting in part from strong sales in Russia. So they're not limited to the UK only. It's very much dependent on how well they're going to do in the future, and really how well they can do with this Argo distillery. If they do create this into a tourist attraction, it does bring a lot of people in, then that gives them sort of some competitive advantages that give them a little bit of stronger barriers against competition, because then, hey, look, you know what, their money is made for a tourist attraction and not necessarily through their brands, so their their operations can remain sustainable by having this tourist location, and then also their brands can grow in the background. Definitely one I'm interested in, but one I'm not buying at the moment. But I like to keep it simple anyway, and that's how I roll, really. I like to invest in stocks that I am personally a consumer of, or understand the business quite well, and I can see why it's growing. For instance, Boohoo, I can see Boohoo Man out activewear in the gym. I see it quite frequently, actually, and I mean, I am wearing it myself too. I'm not looking in a mirror only, although despite common belief where I might be just doing bicep curls in the mirror, I can see this, and maybe this is a form of positive reinforcement bias, where I'm only looking for these brands, but I'm always trying to keep an eye out, especially when I'm doing a shift in the pub each week. Again, I'm looking and keeping an eye out for the brand, seeing what's going on. And I was actually asking around, like a few of the girls that work there, I was asking, okay, so where do you go shopping for clothing, for instance, like Zara, they mention, and I asked, okay, yeah, ASOS as well. I'm like, what about Boohoo? And they're like, the products are a little bit cheap, they're a bit flimsy. I was like, well, okay, what about Pretty Little Thing? And they're like, yeah, actually, I quite like the products at Pretty Little Thing. They're a little bit on the thinner side, but quite like them. And in a way, I'm like, yeah, Boohoo owns Pretty Little Thing, so there is something there. They don't know that usually. And it's quite interesting. So what I'm trying to do perhaps is hone in on my skills when talking to people and really asking these questions, because I feel that a good way to find companies that are doing quite well that may not be known by institutions yet is by being perhaps a consumer, just being a person and doing things in your everyday life. Someone might be going to me and going, oh wow, this Samsung phone is really helping, and I might get this a few times. I might go, okay, I might look into that Samsung company and see what they're really doing. Are they grossly undervalued, for instance? And I think that is what is really changing my strategy at the moment and over time. I feel that at the moment it's certainly changed up the way that I'm thinking. Instead of looking for perhaps stock picks or recommendations that might appear by some users, instead I'm now dedicating my time into researching stocks that perhaps I don't think I've heard of before. Obviously, Boohoo and Games Workshop are exceptions to that because they are quite popular. And Games Workshop may be on a decline now in particular because that's how it may be rolling. And in fact, I do believe I bought an additional share of Games Workshop this week, not because I'm bullish and I think the price is going to go up massively from here, but just literally as a scale in, a little bit of money here. I do think there's definitely room for the valuation to come down at the moment, which may be a concern, for instance, because there is still a lot of discontent in the community. But as someone that is holding the stock, I may as well take the opportunity to slowly chip away and lower that average where possible. And if you'd like to see my stock analysis on Future PLC, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a fantastic day. And don't forget, I'll be live streaming my Q&A on Monday, the 24th of January.